Hi friends, as promised, I'm back with one more video. The video is going to be on end-to-end package on Butterfly. When I say I mean it, you guys are going to enjoy this video. Okay, so this is like complete package on the Butterfly. So basically we'll start with like what is Butterfly, does the Greeks have impact on Butterfly. So rather than me reading out all the points, okay, I'll take you through one each point. So what is Butterfly? Okay, let me take you to Sensible. As we all know, let me directly show you. Okay, what is Butterfly? Right, what do? We buy one, we sell two, and we buy one, right? This is the Butterfly for you. Okay, we sell two quantity of call, and then taking the equal strike gaps, we buy one CE on the upside and the downside. So this is the typical Butterfly for you. All right, we can just deploy the same thing on the put side also. Let me just shuffle it to put. Okay, I'm just tapping on it. This is your put Butterfly. So there is no difference between the call Butterfly and the put Butterfly. It all depends on the view. Okay, let me take it back to call Butterfly. So this is the general definition, right? Whenever you talk about the Butterfly, whenever you go for any YouTuber, they say that this is a typical Butterfly. But I'll describe the Butterfly in a unique way. Okay, so now what I'll do, I'll take you to the new window. Okay, I'll deploy one debit spread 38,500 and 38,900 for the simple reason being same, right? 38,500, this is my original Butterfly. 38,500 and 39,000 sold position. So this is my typical debit spread. You all know, right? This is a typical debit spread. You got 675 premium and you paid 320 premium. So net this is a debit spread. Okay, I'll take you to the second window. What I'll do, I'll sell 39,000 and I'll buy 39,500. So what is this? This is your credit spread. Okay, because we received 320, we paid back 104. So this is a credit spread. So basically if I say Butterfly is combination of debit spread and one credit spread, so will you be okay? Okay, so rather than me telling this is the Butterfly, yes, this is the typical Butterfly. Whenever we say the Butterfly, this is the image or the payoff graph you get in your mind. So rather than me telling this is Butterfly, if I drill down, right, if I just go into like more details, rather than me saying that Butterfly is a combination of two sold and one buy on the upside, on the downside for the same instrument, meaning like for the call and for the put. Okay, rather than that, I'll say Butterfly is a combination of one debit spread and one credit spread. This is your Butterfly. If you look at this thing, the same thing, 38,500 and 39,000. Okay, 38,500 and 39,000. The only difference is like two quantity, right? My credit spread, again I'm starting with 39,000 CE sell, and then to make it a credit spread, I bought 39,500. So combination of your debit spread and a credit spread is your Butterfly. Okay, pause the video and just go to Sensible and deploy the trade, and you by your naked eyes you see the difference. The reason why I'm stressing out on combination of debit spread and a credit spread is this will help you in terms of doing the adjustments. If I directly start that Butterfly is a combination of two sold, one buy on the upside and downside, you'll not be able to understand. Rather than that, if I say your Butterfly is combination of one debit spread and one credit spread, so your adjustments will become very easy. So you have to do the same adjustments what you have done for your debit spread, you have to do the same adjustments what you have done for your credit spread. So if you can just combine your debit spread and credit spread adjustments, you are all good to do the adjustments for the Butterfly. And I'm sure you'll not find this kind of concept. See, honestly, I've not find any such concept on the YouTube, but at least I'm just giving you like more details. Maybe for few people it might look very basic, but this is what I meant to say, right? Combination of one debit spread and credit spreads. Okay, let me take you back to the presentation. Okay, does Greeks impact the Butterfly? Okay, let me take you to the Butterfly now. Let's go to the Butterfly. Let's go to the Greeks. Okay, see, basically the reason we took at the money, right? So maybe for that reason it is showing like minus 282. Basically your debits, your Butterfly is a sort of neutral strategy. Okay, if you look at the payoff graph, you have very less loss, right? 3,000 loss and 9,000. So ideally butterfly is a directional trade, I'll let you know. But does this have any impact on the Greeks? I would say no, right? Not directly related to any Greeks, because this is a Vega neutral trade, unlike your credit iron fly. What is iron fly basically? See, what is iron fly basically? Basically iron fly, okay, let me take a new tab. Okay, see, if I want to convert this to iron fly is basically the combination of two credit spreads, one call credit spreads and one put credit spread. So if I want to make this as a iron fly, you know, right, if you just add a put credit spread, so this will become your iron fly. Okay, let me give it a try. Okay, 39,000, right? You should know the difference. Okay, I'll sell this thing and I'll go for 500 points. So let me buy this thing. So this is your typical iron fly. Okay, if you look at your payoff graph, this is your typical. So this is basically combination of, right, one what is this, your put credit spread, and this is a combination of your one credit call spread. Okay, I'll just delete this because we're not discussing about the iron fly, we are discussing about the butterfly. Alright, so Greeks will not have much impact on the butterfly. This is basically Vega neutral trade. Okay, let me take, can butterfly be directional? Yes, butterfly can be directional. So what I'll do, see, whenever we go for the butterfly, right, it is not something like every time you have to go for the add the money and sell to call and then equal by having the equal distance on the call side. That is not the butterfly. Butterfly is always all about your based on the chart, right? You have to deploy the butterfly based on the chart. So let me give you an example. Okay, let me give you an example. So let's say this is your price action. Okay, this is your price action. Your price stands somewhere here, right? You have the view of, let's say for the next expiry, you have the view of maybe market will go up and it might take the resistance of this area, of this line. Okay, so if the market stands at this support level, and if your view is if the market can slowly go up and it might take a resistance over here, right? In this case, what you have to do is, what you can do is like, right, you can just deploy a butterfly, meaning you have to sell to it could be your call or it could be a put based on your view, right? You have to sell, you have to just deploy the butterfly here, right? This is your butterfly shape, right? Okay, and ensure that you are, see, when it take resistance, so either market can stand here or maybe market can fall down, right? So typically you can have your butterfly something like this, simple. So market will go up, right? It will take a resistance, so it might come down till this position, or it might just give a false breakout. It can, so you will be able to trap your market into the butterfly, right? This is the way we need to deploy the butterfly, rather than you just going to the ATM and just selling two call or two puts and getting the edges. Let's take another example, right? This time, let's say your market is at the resistance, and you know, right, by the expiry the market can come and take the support of this support zone. So what you will do, you have to deploy the butterfly, right? You sell to call or put and deploy the butterfly. That's it. Okay, so let's say this is your butterfly. So let's say market comes here, if it takes a resistance, so you'll be able to trap the market within this cone area, butterfly area. Okay, this is the way you need to deploy the butterfly. So that's what I meant to say. Butterfly are a sort of non-directional, and also it can be directional. So I'll show you one example of directional. Okay, I'll show you one example of directional. So this is typical non-directional. So what did we say? Let's say if the market, if you're able to trap the market at this, at your resistance, so you'll get into your full profit, right? If you're able to trap the market within this cone area, not say at the exactly at the center of the cone, even if you're able to trap the market here or here, you will be able to get into the profit. Okay, so let me take you back to sensible. Okay, let me delete everything. Let me delete even this thing, right? So I want to deploy a call butterfly with a directional, meaning my view of the market is sideways to bullish. Simple, friends, sideways to bullish. My view of the market is sideways to bullish. Okay, I'll go to the option chain. Okay, what did I say? Sideways. So 39,000 is the your current market price. So what I'll do, my view is bullish. So what I'll do, I'll just go to 39,500, I'll buy, okay, and then I'll go to 40,000, I'll sell 2, okay, and then I'll maintain the equal distance, 500 distance, right? I'll go to 40,500 and buy, and this is my butterfly. This is a sort of directional butterfly. Market stands here, but my view, what did I say? My view is okay. I'll do one thing. I said sideways to bullish, right? Okay, let me go. The market stands at where it is standing, 39,000. Okay, 39,000. Rather than me going for 39,000, I'll buy 39,200. Right, 1 2 3 4. I'll sell 37,900, 2 quantity. Okay, I'll have the same equal distance of 500 points, 1 2 3 4 5. I'll buy this thing. Simple. So this is my view. This is my view based butterfly, because my view is sideways to bullish. Market stands here at the vertical line is where the market stands. Now what did I say? I said sideways to bullish. So when I say sideways to bullish, so do I need to have this loss area on the call side? No, right? Because my view is sideways to bullish. So generally, if my view goes right, then also I'll be able to get into loss. Got my point? So when I say sideways to bullish, I need to have this red area mitigated whenever I'm deploying the trade. So what I'll do, if I unselect this, right? This is my typical broken wing butterfly. Because I do not have the wing on the right. If you look at this break even, this is 40,100. Okay, this is my break even, 40,100. So what I'll do, I'll buy one strike below my break even, so that my call side loss is completely mitigated and I'll be getting into green. So let me show you, right? I'll select back this. So 40,200, I'll go 100 points down. Okay, see, my loss has been mitigated to almost 313. Even this is not fine because my view is sideways to bullish. Again, what I'll do, I'll go 100 points down. That's it. So this is my directional butterfly. Hope you are getting my point. This is my direction. This is the beauty of butterfly. You can go for directional. You can use the butterfly as a directional trade, as a non-directional trade also. Just in case if you do not have any view of the market, you go to the ATM, sell 2 calls, equal distance, you buy 1 call and buy 1 call upside and downside. So your market will be in the center of your cone. So it will support on the downside, it will support on the upside. But now what did I say? My view is sideways to bullish. So this is the beauty of the butterfly, because on the call side, if the market literally goes on the upside, so I do not have to do any adjustments because my upside is already locked with the profit. And if the market becomes sideways, like if it gets trapped in the green zone, I'll get more profit. So my risk to reward would be like 3,000 versus 9,524. Okay, so let's say if your view is bearish. Okay, let's say your view is bearish. Okay, sideways to bearish. So market stands same at 39,000. So what I'll do, I'll go for buy. Let's say I'll go for 39,000 buy, right? 1 2 3 4 5. I'll sell this 2 quantity. Okay, and then equal amount of this 1 2 3 4 5. I'll buy back this. So this is my typical butterfly. But what did I say? My view is sideways to what? Sideways to bearish. So I do not want this red area. So what I'll do, if I select this one, okay, what is my break even? Break even is 37,900. So I'll go for 37,000. Let me see, right? If I, sorry, not this one. Okay, sorry. Okay, see, this is also not the view what I have. So I'll go like 100 points down. That's it. So this is my typical directional butterfly on the put side. All right, this is my typical butterfly on the put side. So sideways, even I'll get into profit if even market makes a down circuit of 5%, 10%, and with a sideways view. If you want to make a typical standard butterfly, you know, right? Go to, already we have seen that example. That's it. You have to sell this 2 quantity, right? Go for 500 points, 38,500 and 39,500. This is your typical butterfly. You'll have safety on the put side, you'll have safety on the call side. So we have seen 3 flavors of the butterfly, right? Your typical butterfly, this is the non-directional trade. We have seen previously, we have seen the call side, that is directional on the call side, and also we have seen the directional on the put side. So let me take you back to the presentation. So we've discussed about, can butterfly be directional? Absolutely, 100% butterfly can be directional. Are both butterfly and ironfly same? This would be an eye-opener video. Okay, what I'll do, I'll delete this. Alright friends, I'll delete this. I'll go to neutral. I'll just deploy a random butterfly, ironfly. This is your ironfly, right? Put, call, sold, and then we bought the edges of the put side and on the call side. Now what I'll do, okay, what is this? 39,000 is the sold position, right? This is your typical ironfly. Okay, I'll delete this. I'll go for this thing. What we did deploy? We deployed the call side, right? 39,000. What is that? 39,000 is a sold position. So I'll go for 39,000. I'll sell 2. Okay, and then 38,500. Same thing, right? 39,500. So this is your butterfly. See friends, try to see this. This is technically, this is a 4-leg strategy, but this will look as a 3-leg strategy because we have 2 quantity of sold position. This is your butterfly and this is your ironfly. This is a 4-leg strategy. This is 3-leg but technically 4-leg strategy. All right, check the risk to reward of your ironfly. 8,985 more or less, right? 9,000, 3,515, 3,515. So I'm just proving you that both ironfly and butterfly are same, provided you are selecting the same strikes. When I say strike, see 39,200, 2 sold positions. At the butterfly we have 39,000, 2 sold position, only we have calls. But your ironfly, already I've described it, ironfly is a combination of put and call. Your butterfly is only call to call or put to put. Okay, now check the probability. 45% is in your ironfly, 45% is in your butterfly. Check the risk to reward. 0.39%, 0.39 loss, profit, everything remains. Your margin is 44,000 in butterfly, same thing 46,000. So hence I've proven that both ironfly and butterfly are same. But there is a one drawback in ironfly. Okay, I'll show you. Just in case if you want, see, what did I say? In the butterfly, you can go for directional trade. Butterfly, you can go for the directional trade, but can you go for directional trade in ironfly? So rather than me telling you theoretically, I'll just prove it. Okay, I'll clear everything. I'll go to the option chain. My view is bullish. Simple friends, my view is bullish. Okay, so what I'll do, the market stands at 39,000. What I'll do, I will sell one. I'm just trying to deploy a ironfly. Okay, what do we do? 39,000 is the current market price. I'll go to 39,000. I'll sell one call. I'll sell one put. Right, I'll buy one edge. 39,000. Sorry, not here. 39,000 edge and 40,000 edge. Right, this is your typical ironfly, directional ironfly. This is your directional ironfly. Yes, absolutely. But don't you think there is a huge deviation between the premiums? 104, just, I mean, this is one of the eye-opener video, friend. This is 104 premium and this is 540. Why do we have 540 as a premium for put and why do we have only 104 as a premium for call? Because this put is in the money. Whenever you go for directional approach in the ironfly, right, one of the leg will become in the money, and you know, right, in the money will have its own consequences of liquidity issues. Right, at the time of deployment it is fine, but the moment it gives a momentum, so getting out of the in the money will be like very difficult. And also when you're deploying the trade sorry, when you're deploying the directional ironfly already sorry friends, again I have cold. So when you're deploying the ironfly, you will already have the slippages because in the money will have bid and ask price, huge deviation of bid and ask price, because this is your OTM but this is your ITM. You got my point? So butterflies are the best for going for directional approach, but ironflies, though many of the people are using the ironfly as a directional approach, which is absolutely, I would say, 100% wrong. Because when you go for the directional approach, one of the leg will become, one of the leg will become in the money. Okay, let me show you one more thing. This is the bullish. Let's say I am bearish about the market. Simple, right? Market stands at 39,000. What will you do? You will go for 39,500, sell, you will sell, you will buy this, you will buy this. Okay, right? This is your typical iron fly. This is your typical iron fly. But now check the deviation, right? Again, your call has become in the money. The moment you deploy the trade, you will have the slippages issues, right? Whenever you deploy the trade, the moment you deploy the iron fly with the directional approach on the downside, already your trade will be in loss because of the slippages, because your bid and ask price, you will find like 10 rupees difference, 12 rupees difference based on the VIX, 13 rupees difference, 14 rupees difference. Even if you are going for single lot, right, 25 into 10, 250 loss directly it will show you. Okay, now the beauty of butterfly is you can go for directional. Okay, already we have seen, right? Let's say the market stands at 39,000. If you want to go for the, if you are like super bullish about the market, sell this one, sell 2 quantity, right? Buy this 1 quantity and buy this 1 quantity. That's it. This is your butterfly. And the beauty is all the strikes are OTM. Maybe this is your ITM in the money. Sorry, this is completely OTM. Maybe 39,000 could be the ITM. At the money, sorry, not ITM, at the money, and this is your OTM. This is the beauty of butterfly, right? Whenever you go for the directional approach, you will have OTM. So OTM strikes will never have any liquidity issues. Got my point? So directional, if you are directional, go for butterfly. If you have the view of the market as non-directional, go for butterfly. If you ask me which one is easy to manage, if you are going for iron fly, definitely your market condition should be sideways, so it is very easy for you to manage with your iron fly. If your view is bullish, if your view is directional, so then iron fly will definitely not help you. This is the thumb rule. Okay, iron fly is meant only for what? Only for sideways market. Your butterfly can be used as a non-directional and also as a directional. All right. So now let me take you to the PPT. Right, difference between butterfly and debit spread. This is very, very important, friend. This is going to be, because the reason why I'm stressing out more time on all the difference between iron fly, between butterfly, iron fly, and your debit spread is like that will help you in terms of doing your adjustments. Okay, I'll delete all the trades. I'll deploy a debit spread. I'll just deploy a debit spread. What do we do? Market stands at 39. I'll deploy a debit spread. I'll buy 39,500. I'll sell. This is my typical debit spread. Okay. Now, okay, what did we discuss here? This is your debit spread. Okay, 39,500 is my buy position, 40,000 is my sold position. So we gave we got 104 rupees debit, we paid 25 rupees. Now what I'll do, the same thing I'll deploy. Okay, what I'll do, let me get it to like okay, I'll make it 1:3, friends. I'll make it 1:3. Okay, 39,500, or else delete, go to this thing, right? I'll go for, where are we, bank nifty. Okay, 39,000. I'll select this one. Buy, half of premium would be 215, is something like 1 2 3 4 5, right? I'll go for sell, right? Yeah. Or else I'll go for this sold position, right? So 1:2. Okay, this is my debit spread. So what I'll try to do now, I'll go for butterfly. Okay, 39,200 sold positions. Okay, 39,200 two sold positions. I'll take the same strikes, and what is it, 39,600. all right, 39,600 buy. And what is the difference? 1 2 3 4. I'll go for 1 2 3 4. Right, this is your typical butterfly, and this is your typical debit spread. Okay, check the risk to reward. Right, you have more good risk to reward in your butterfly. 2,000 is your loss, 7,000. See, we have taken the same, more or less the same strikes. See, 39,000 sorry, 39,600 is his sold position, right? Okay, let me see. 39,600 was a sold position, and then 200 is 400. Okay, so I'll make it 40,000, right? I'll make it 2 quantity. I'll make this 1 quantity. Am I doing something wrong? 39,600. Okay, I'll make it 40,000. Okay, yeah. Yeah, so this is your butterfly. So you'll have the more or less, see, this is your butterfly and this is your debit spread. So check the risk to reward, right? It has a good risk to reward. Probability is less, obviously, right? Your probability POP will be less because market has to expire within this code. But check your debit spread as more range, right? You have capped your profit on the debit spread, but whereas in the butterfly your scope is limited till this break even. The moment the market goes behind your break even, so you'll fall into your loss area zone. But check the risk to reward, 8,000 to 2,000 in your butterfly, 6,000 to 3,000 in your debit spread. But check the loss is more, 3,348, but your loss is only 1,914 because we are giving very less debit. Okay, if you look at your debit, if you calculate, pause the video, you calculate how much of credit you're receiving, how much of debit you're giving your butterfly. So obviously you will end up giving more debit in your debit spread compared to your butterfly. So there is not much difference, but difference is in your view. If you are like super bullish about the market, go for debit spread. But if you think that market has a very strong resistance at 39,600, so then go for your butterfly. Okay, you pause the video and see the difference actually. So if you look at this, right, if you're super bullish, even if the market opens like 5% upper circuit, you will get your profit. But whereas in your butterfly, you have the more profit range, 17%, whereas in the butterfly it has like 26%, but there is huge loss is 13%, but loss is only 4.2. It's a huge difference, right? So that's what I'm telling. Whenever you have the sorry friends, yeah, sorry friends, whenever your market view is sideways to mild bullish, go for butterfly. Whenever your view is sideways to super bullish, go for the debit spread. Okay, that's it. So now let's come back to the presentation. So we have discussed about what is butterfly. Does the Greeks have impact on butterfly? Can butterfly be directional? Very important sessions I've discussed with you friends. Are both butterfly and ironfly same? Yes, you have to do the practice. They both are same provided you're selecting the same strikes, right? There is a myth in the market saying that butterfly and ironfly are two different things. No friends, I've just proven you difference between butterfly and debit spread. The reason why I'm stressing on this thing is this will help you in terms of doing the adjustments, because end of the day butterfly is a combination of one credit spread and one debit spread. Can be deployed based on the chart. Yes, we have seen, right? You should not be randomly deploying your your butterfly. You have to take the help of the chart and then you have to help. We have seen butterfly can be non-directional, butterfly can be directional. Now coming back to the adjustments, friends, believe me, right, when I started the session, when I said butterfly is a combination of debit spread and credit spread, so don't you think all the adjustments of the debit spread and the credit spreads are applicable? Absolutely yes, absolutely yes. That's what I keep telling. All the strategies are built upon your straddles, your strangle, your debit spread, your credit spread, your ratio spread. That's it. If you're good at these 5 strategies, you can manage any of the trade. Do not buttify the adjustments. When I say adjustments are very dynamic, because all your so-called strategies are composed of your straddle, again I'm repeating, your strangle, your debit spread, your credit spread. That's it. And what is strangle? Basically one naked call, when sell when naked call, what sell. What is straddle? Basically at the money call and put sell. What is debit spread? You go OTM, buy one thing and you go somewhat OTM, you sell. So I needless to say, because I've made like 40, 50, 60 videos on debit spread and credit spreads, right? So let me give you, see, I'm planning to make all these adjustments videos in a separate, but let me give you a quick what do we say, sort of teaser on all these adjustments, right? All the adjustments of the debit spread and credit spread are applicable. Adjusting by deploying new butterfly. So what do I mean by this? Let's say you have a butterfly. Okay, let me show you directly here. Do we have any butterfly deployed somewhere? Yes. Okay, I'll do one thing. I'll just go to this thing. I'll deploy. Okay, this time we will deploy 2. I'll just give a teaser how the adjustments, and then I'll make a very detailed video about one each this thing, right? This is your butterfly. So you're not supposed to do any adjustments until and unless your break evens are breached. Until and unless your break evens are breached, you're not supposed to do any adjustments. So let's say your market has raised one of your break even point. Let's say your market has raised, I'm just trying to simulate. Let's say your market has raised your break even. So what you have to do, right? When I say you can adjust by deploying a new butterfly, simple friends, you have to deploy a new butterfly. That's it. Whenever your break even is breached, you have to deploy, you have to select the strikes in such a way that you have to deploy one more butterfly. That's it. Okay, so ensure that whenever you're deploying one more butterfly, okay, sorry, let me draw it neatly. Okay, I'm just using the mouse. So what I mean to say is like you have to, okay, let me take a thick pen. Okay, you have to deploy one more iron fly. That's it. So maybe your market will stand somewhere here. All right. So when the market breaks your break even, so you will be deploying your butterfly, second butterfly. See, butterfly takes only 40,000 friends, right? It will not consume more margin, right? You have very minimal loss, right? Whenever you're deploying your second butterfly, right, all the smart traders might be thinking that this loss will increase because every butterfly has its own loss. So that loss will end up on the call side, that loss will end up on the put side. So whenever you're deploying a butterfly, ensure that you are buying the edge of the butterfly in such a way that you have to, whenever you have the break even, right, so ensure that you do not have the loss on the call side. So you have to select your break even in such a way that your loss on the call side should be mitigated because the market is going on your call side. Okay, I'm just giving you a teaser. I'll make all the videos. Okay, now what should you do to mitigate this loss? Simple friends, your market stands here, right? Market stands here. So let's say this loss is 3000, right? 3000 divided by 25. So if you get like XYZ number of points, right, just go ahead and sell one naked put, deep OTM naked put, in terms of covering this loss at one time, at one go, two go. I'll just leave it to you. If you are an aggressive trader, you can go for one go. If you are a conservative trader, divide this entire points divided by 2 and just go for 2 this thing. So sell one naked put, right? If the market keeps going up, this will give you profit, and then exit this and go for one more quantity. So by this, what will we do? You'll be able to mitigate your loss on the put side, and anyways, right, you are selecting the strikes in such a way that your call side loss is mitigated by selecting the strike. So you should not be selecting the strike in such a way that your call side should start showing the loss. Okay, maybe it is difficult for you guys to understand, but stay with me, right? I'll make all the videos. So this is, and let's say your market stands again here. At max, you can go for one more butterfly. That's it, friends. One more butterfly. So when the market stands here, right, so when you deploy one more butterfly, it has its own loss. That loss will add up on your call side and put side. So you have to play very smart in terms of mitigating that. See, butterflies, say honestly friend, butterfly are a peace of mind. It will not have huge loss because it's end of the day, it's a debit strategy. The less the debit you give, the less the loss you will have. So I will not go for butterfly this way. Definitely I'll not go for butterfly. This is not my butterfly. My butterfly would be, I wanted to have only 3% loss and then maybe like 6 to 8 or 10% of profit here, right? Just for the demonstration purpose I'm giving you this example, but I will select my strike. Okay, let me show you one thing, right? If I select, see, this is what I mean to say, friends. So when I say, see, right, your loss is almost like 3,484. So if you get 100 points down, see, your loss has become 1,796. Again, if you get your 100 points down, your loss has become almost zero on the call. So this way you have to select your premiums. Okay, let me take you back to, so we have discussed about this thing, rolling up, rolling down the winning leg. Simple, friends. See, I'll tell you again, I'll get it back to, see what you have to do. Basically, let's say I'll reset your this thing. So let's say your market stands here, right? What did I say? Butterfly is a combination of debit spread and credit spread, right? So when the market stands here, right, you have your debit spread and you have your credit spread, right? When the market stands here, definitely your debit spread will be giving you profit. So what you have to do, you have to roll up your winning leg, right? You have to roll up. So what is your this thing? 39,500. You exit this 39,500 and you go for 39,600 or 39,700 based on where your market starts. So if I said directly 39,700, people will jump on. See, it depends. Adjustments, shiftings, all depends whether you're on Monday, Tuesday, Wednesday, Thursday. So that's what you have to slowly, gradually do. Exit this profit, go for 39,600, right? The moment you do this, you should not be leaving this leg. Even you have, see, whenever you have to move this also 38,500, right? You have to move to balance it back to butterfly, because the payoff graph will deviate. That's what I meant to say, right? Rolling up, roll up or roll down the winning legs with reverse buying on the opposite side to get it back to the butterfly. Stay with me, I'll show you all the adjustments videos. Converting to strangle, this is one of my what do we say, favorite, right? Let's say you deployed a call debit spread and market went against your view, right? Market stands here, right? You are in loss, and believe me, butterfly will not show you this loss. It will show only on the expiry day. Even if you see, your loss will be like only 2,476. This loss will be shown only on the expiry day. Let's say market stands here. So what you have to do, simple, friends, simple, right? Butterfly will show you loss only close to expiry, maybe on Monday, Tuesday, because this is a debit spread. This is not like your debit spread. This is a sort of Vega neutral. This we are giving very less debit. Okay, what you have to do is, like, when let's say the market stands here, exit these two buy positions. That's it, friend. Exit these two buy positions, and whatever premium the call is trading at, whatever premium, let's say this is trading at, let's say 30 or 40 rupees, right? Because close to expiry, this will become 30 to 40. That's it. You have to sell one put and convert this to strangle. That's it. The beauty of this one is, like, when you go for 30 or 40, you will get bigger range, right? You will be able to convert this to strangle, and you have to just manage it for Tuesday or at max Wednesday and Thursday. And we all know, right, the theta decay happens drastically on Wednesday and Thursday, unlike your debit spread, wherein your theta decay will slowly happen, right? Debit spread will have more debit, right? You will get into that panic situation very quick, but your butterfly will have very less debit for you to get into the panic situation. You will not get into panic situation on Friday if you're deploying the butterfly on Thursday. You will not get into panic situation on Monday. You will not even get into panic situation on Tuesday. But on Wednesday, when you deploy this to strangle, right, with just the overnight theta decay, you will be able to mitigate your loss for sure. See, whenever we are talking about the adjustments are to mitigate the profit. If someone is again using it as converting it to profit, then God will help you, right? You will be able to make your strategy zero loss on the Wednesday itself. I'll make a very good video on how to convert to strangle. You can convert it to strangle and also play on the intraday if you are worried about the gap up and gap down, because Wednesday you'll get more premium decay. So it's end of the day, see how much debit you have to cover. Only 20-30 points of the debit what you have to cover, at max 40 points. So within Monday, if you are selling 20 rupees of put and 20 rupees of call, you will get 80% of your your debit in terms of strangle convention, because your theta decay happens on what? Wednesday during the day, Wednesday overnight, and Thursday. Okay, this is as good as exiting these two legs and converting it to strangle, the way we have done it in the debit spread. Alright, so we have discussed about converting to strangle and also converting to naked selling. So rather than, if you do not have the capital, right, rather than selling this, exit these two legs, buy position, leave your two call naked positions, that's it. Because market right, are we no, I think this will not work here, friends. So because market is going up, right, when the market is going up, so yeah, so we can just, I'll cover this example in one of the videos. So maybe I'm not sure like why I've put this converting to naked strangle. Okay, I'll come back to this thing. Naked selling, this is one of my favorite. It's simple, friends. One of the simplest adjustment of your butterfly is like, you have to just cover this loss. Let's say your testing side is this thing, right? You have to cover by, let's say 3000. Let's say, what is your loss? See, my butterfly will not have this much of huge loss, because I'll definitely select my premium and strike selection, wherein I'll ensure that I'll have worry, but still I'll say divided by 25. Okay, 140 divided by 2, that's it. So now I'll try to cover 70 rupees 2 times, right? I'll try to sell 70 rupees, you know, right? We have already seen all these things. I'll try to select the put for 1, that's it, right? When I do, so my loss has reduced from 3000 to 1630, and if the market keeps going up, what I'll do, I'll exit this 74, and then I'll just increase the quantity to 2, that's it. I'll take one more P, that's it. My loss has become 0. Butterfly, believe me, friends, butterfly is zero loss strategy. If this is one of the simplest adjustments what you can do, though my PPT, though my slideshow looks very complicated, but this I'm telling from the learning perspective, right? You should know all the different permutations and combinations. Okay, simple. With the naked selling also, from the opposite side also, you will be able to what? Mitigate your, just in case if the market takes a reverse turn, U-turn, you will still have the potential of getting 4% profit. Okay, this is just a trailer. I'll make all the adjustments videos. What did we discuss? Naked selling, naked selling from either side to cover the extra debit, that's it. Yeah, I mean it, actually we have discussed squaring off the DS or CS and managing the pending, right? What do I mean to say is, what do I say? Debit, your butterfly is the combination of one credit spread and one debit spread. So let's say you have deployed your debit spread here. Okay, market is somewhere standing here, right? So what does that mean? You have your debit spread, you have your credit spread, right? So do you want to still hold this debit spread, because market is standing here, right? Your debit spread might have given you the complete profit, 90% of the profit you might have got it, but this is the one which is giving you loss. So what my adjustment would be, exit this debit spread, leave this credit spread and manage this credit spread independently. Now, how will you manage? The same adjustments what I've told you in the credit spread series, the same will get applicable for this. What is credit spread basically, right? What is iron fly? You can convert your credit spread to iron fly also, because iron fly is a combination of one CE credit spread and one PE credit spread. So I'll show you how to convert this credit spread of the CE to converting it to iron fly by deploying a put credit spread. So then this will become your typical again iron fly. Your market will stand somewhere in the between, so it will be easy for you to manage. Stay with me. But what I need I need comments, I need interest from you, right? I mean, based on that I'll make all these videos, right? That's what I meant to say. What did I say here? Right, squaring off either of your debit spread or it could be credit spread, right? Either, vice versa. right? Let's say the market has come here, right? The market stands at your this position, then your credit spread will be giving you profit, your debit spread will be giving you loss. Exit the credit spread and manage the debit spread independently. What are the adjustments of debit spread? I've shown you 10 to 12 different adjustments of debit spread. You can convert it to ratio spread, you can convert it to strangle, you can convert it to ladder, you can convert it to again butterfly. So there are like n number of adjustments. Okay, 1 second friends, 1 second. Okay, okay, what, right? And then what did I say? Squaring of either of and managing independently, converting the credit spread to iron fly. That's what this is going to be like. Very interesting video, friend. I'll show you how we can convert the credit spread to iron fly. Converting the debit spread to ratio spread, we all know, right? That's the beauty of the, and then shifting the sell position. There is one more adjustment, and this is one of the simplest adjustment. You guys will enjoy this, right? Stay tuned for my adjustment videos, friends. I mean, this all videos are for free, right? I mean, I do not want to quote again and again, but show me one video wherein like you'll find all these adjustments, wherein like people have discussed about so many adjustments with free. Okay, now the last adjustment, this is going to be like very good. Shifting the sell position, meaning this is your butterfly. Okay, this is your butterfly. Let's say the market stands somewhere here. Okay, you are into your loss zone. So what you have to do is like, you have to move your sold position, you have to roll up your sold position. That's it. So whenever you roll up your sold position, no doubt you will be decreasing your range. See, whenever your view goes wrong, you do not even think about the profit. See, whenever I make the adjustment videos, right, I know definitely I'll come up with some comments wherein people will say this will decrease your range, your profit. See boss, your view went wrong. When we do the adjustment, why are we doing the adjustments? Because our view went wrong. If your view went right, do we actually need the adjustments? We need only shiftings, wherein we will be like able to locking up your profit. But when your view goes wrong, right, we end up doing the adjustments in terms of mitigating the loss. I said mitigating the loss, forget about profit. Okay, now what I'll do, if the market comes here, slowly I will roll up my sold position. So 39,000, right? I'll roll up to 39,100. Slowly, depends on how far or close we are to expiry. The moment I do this, I'll be creating some credit. This loss will be mitigated by 30-40%. Let's say the market again went up. Simple, because end of the day, butterflies has very less debit. It's very easy for us to mitigate that loss even very close to the expiry, because it is unlike the debit spread wherein we give huge debit. This is low debit, right? The moment the market stands again here, I'll again roll up. The moment I roll up, I'll go to 39,000, what? 39,200, right? Now, do I need this buy leg? No. Do I need this buy leg? So wait for all my, so should I only shift my sell position, or along with the sell position do I need to shift the buy position? So I'll make a simulation video on this thing, so stay tuned for video. So whenever I'm rolling up my sell position, slowly this loss will be mitigating, and you will have something like this. Literally you will have a shape something like this. Okay, so this will convert to profit. See, when I say profit, don't look out for profit. The moment you make it zero loss, exit from the trade. Do not hold into the trade, because your view went wrong. The moment you are able to mitigate your loss to zero because the view went wrong, exit the entire trade. Again, if you are doing the firefighting in terms of getting into profit by getting your greed into picture, right? I mean, no one can save you. Okay. That's it. I think we have discussed about so many. I think another, like, I'll be making another like 5 to 6 videos on each adjustments, and I think, friends, believe me, see, when I say, I mean it, right? We are almost at the end of the session. This is going to be like end-to-end package on butterfly. You do not need any other videos on the butterfly. And did I say this is end of my adjustment? Right? Did I say this is my end of, yeah. Before we conclude the session, these are the pros and cons of the butterfly, right? I'll let you know when to deploy. So what I feel is like deploying 9 days to expiry will be like better restricted, but this I've not yet decided. Let me do some back testing and see whether is it good to deploy 6 days before or 9 days before. Easy to manage and will not give you panic in case of huge gap up and gap down. Butterfly will not give you any panic on gap ups and gap downs, believe me, because end of the day you will have only very less debit, right? It can sustain a gap up of 10%, 20% also. No impact with Greeks on the trade we have seen. One or two adjustments are sufficient to make the trade green. That's it. One or two adjustments. Once your trade becomes green, the trade can be used as a reference trade, then plan to increase the credit, right? By taking the advantage of Wednesday 3:20 p.m. and Thursday 9:20 a.m. Okay, right? Less debit, less panic. The less the debit you give in your butterfly, the less the panic you'll have, right? And to cover this less debit, to cover this less debit, right? Even you can cover this debit on close to the expiry, because debit spread as huge debit, you will not be able to mitigate your loss, but whereas in the butterfly you'll be able to cover even on Wednesday and Thursday. Almost zero loss strategy in case of you going wrong, right? Covering the debit pair is easy by either side, right? As the debit is less on close to the expiry day too, even on the close to the expiry day also you can cover, right? Many adjustments are available based on your trading style. Low margin required, peace of mind trade, for especially for office goers, especially for people like me. Good for volatile market conditions, especially during this volatile market condition. You can just deploy the butterfly with confidence, because this doesn't have anything to do with your Greeks. This can sustain gap up of, because end of the day your loss is only 1000 per lot or 1500 anyways, which you can cover them on the last 2 days of your trade. Thank you friends, thank you for watching my videos. So stay tuned for my adjustments videos. Okay, so maybe give me like a day or two, I'll come up with all the adjustments. But the only thing what I expect from you guys is like, I need comments from you saying that yes, I need the adjustment videos on the butterfly, right? This all are the adjustment videos. Okay, thank you for watching my video.